do something there. So we got two potentially really good things that are going to happen towards the end of this year. We got capital expenditures holding up, and we also have potential for corporate tax reform out of that super committee. And that's the best news I can present to you today. And with that, why don't I end it there, and why don't we open it up for some questions?
Andrew, thank you for your comments. And as expected, we have an inquisitive bunch, and we do have quite a few questions here, and we'll go through those quickly here at the end. Andrew, given that most folks in the audience here trade U.S. dollar securities, can you talk about the correlation between the strength of the dollar or the weakness of the dollar and the volatility direction of the stock market?
Well, I'll tell you, it's highly, highly correlated. I was looking at some studies just this week, and they're looking at the euro, and just over the last month, it's been the highest correlation between the euro and the stock market, not only for this year, but probably for the last 5 years. Well, actually until 2008, I would say. We're back to those levels of correlation, like 0.72. So inversely between the euro and the stock market. It is just so, it's not one-to-one, but it's darn close right now. So what does that mean? It's risk on, risk off, baby. I mean, everybody from one side of the boat to the next. And that's kind of my point about the binary type of environment that we're in. So they're very, very highly correlated.
How about predictions on the direction of the euro between now, the end of the year, and into the middle of next year?
Right. You know, my show is very short-term orientated. I will tell you this with a big disclaimer. Anybody who tries to predict out about 12 months in currencies is at best being disingenuous. So I would say this. It's a fascinating dynamic right now because what happens is that the United States has the easiest central bank on the planet, right? The Fed is by far the easiest central bank out there, and it wants to do more. If you looked at the minutes this week, they said that they were contemplating doing more quantitative easing. So what does that mean? It's really negative for the dollar. Bottom line. Fed is, in essence, trying to devalue the U.S. dollar. The problem is they've got Europe there. Europe is a disaster, right, as we know. If we can get Europe to stabilize, I know that's a big if, wherever that happens, I'm looking for a major rally in the euro. I'm not sure where that's going to be. The bank recapitalization plan is going to be critical coming up over the next 3 weeks. If they do it properly, we should see the dollar sell off into the end of the year. I would say, you know, the fact that we're just around, you know, today I think we're around 138 for the euro. I would say we'll see some volatility over the next 3 weeks, probably trade between 133 and 138. If this bank recapitalization program is done properly, my guess is by the end of the year, if the clouds clear a little bit, we're going to see the euro pushing 145, maybe as high as 150. And that's as far out as I'm going to go.
Fair enough. There seems to be some nascent anti-regulatory, anti-over-regulatory stuff going on in Congress, and a couple of the questions were about hoping that that spark is fanned and flames and turns into something. Any hope?
As far as overregulation goes?
Anti-overregulation.
Oh, anti-over. Yeah, I mean, I think it's instructive to hear what European banks said about the recapitalization plan that was somewhat leaked out a little bit. They said if they have to go to the private sector to raise money, it's not going to happen. What they'll do is they'll reduce their balance sheets, sell assets, shrink. And that's what is proposed. I mean, that's kind of the future of what's going to happen in the United States, too. We have to increase our capital, our Tier 1 capital ratios, right? So we know that banks have to raise more money. We also know that Dodd-Frank is extremely onerous as far as hurting banks. I mean, you can say it's for the safety of the bank, great. But in the short run, you're going to have less lending because of it. So there is quite a bit of pushback on this. I don't think they'll be able to like repeal and replace it, but I do think there's a lot of pushback, especially on things like the Volcker rule. I mean, I come from a bank, you know, a Canadian bank. We obviously were kind of the virtues, we're the paragon of virtue when it comes to finance, and that's usually you don't use those words in the same sentence, but we didn't engage in a lot of the activities that U.S. banks did. Now, having said that, You look at the U.S. and say the Volcker rule, why would you do that? I can understand that you don't want to support risk-taking, right? We don't want the FDIC to support risk-taking. On the other hand, that type of trading did not create any of the issues that occurred in 2008. They were all real estate related. I mean, if you really wanted to get at the heart of the problem, why not ban real estate lending? Because that's the biggest problem out there. So I think it's misguided with what they're trying to do in just completely changing the overall regulatory environment for banks overall, because it creates, again, uncertainty. And it makes banks not want to lend as much. It also hurts banks because the #1 hire at most banks are risk managers and compliance people. Honestly, that's where most banks are hiring. I mean, B of A just announced today that they're laying off like 325 equity traders in New York. That's the problem. You're creating costs for these guys, and you're not really dealing with the most salient issue of addressing risk within their lending portfolios. And so I would hope that, cooler heads will prevail. And I would say it really depends on Congress. Congress, we've got a Republican House, which will stop or try to stop some of the regulation moving forward. By the next election, we'll see what Congress looks like, and that will give you a better idea of how far Dodd-Frank will go.
Terrific. One last question came up a couple of times. A year from now, there'll be probably 2 candidates running for the White House. Who will they be? And then a year and about a month from now, who will win?
Well, we know one candidate that's going to be there, we think. We believe President Obama will run again. Now, on the other side of the equation, it's fascinating to see what's going on there. My belief is that it really doesn't matter. I don't want to sound too flippant, but I think you could run a dog catcher next year, and he will beat President Obama. And here's why. 9% unemployment. 77% of the people think the country's moving the wrong direction. Those two things aren't going to change a whole lot because unemployment's not going to go back down significantly, and people's opinions will still be quite negative going into next year. The likely candidate would be Romney, and a ticket of Romney and Chris Christie will be almost impossible to beat. And I don't know what President Obama is going to do, but to me, he looks very, very likely to be a one-term president. Now, if that's not the case, right, okay, that's fine with me. I just want people, whoever's in Congress and whoever's in the presidency in the White House, I want them to pursue policies that are pro-growth. And it's not creating a jobs bill because that doesn't work. It's cutting corporate taxes, flattening the U.S. corporate tax code, and also flattening the individual tax code, eliminating some exemptions, and just making it so much more simpler. I think that will go a long way towards helping the U.S. economy. Again, it's not perfect, but that's what I really like to see. So whatever candidate supports that, I really don't care. I mean, it doesn't matter to me. I'm a markets guy. I'm just looking at for how I'm going to make money. So why don't I end it there and say thanks very much.
Andy, thank you. Thank you, Andy.
You bet.
Terrific job.
Okay. Thanks.
Okay, we're not done. We're almost done, but we're not done. It's the moment many of you have been waiting for, which is today's iPad drawing. And those of you who visited the exhibit hall will remember walking around, perhaps madly walking around, getting your cards punched by each of the sponsors. And we have a basket full of the cards that were punched by all of the sponsors. And Erica Rodriguez is going to bring it out. And I'm going to pull a name out of the hat. Now, here's the deal. You have to be here. And so if I call a name, well, you have about 8 seconds to call the guy who gets picked and get him in here. Or we're going to pick another name, and that person will get it. So if you're here, make yourself known. The other thing that I have to tell you is you will not get an iPad tonight. We're all about customization. We got to know about your cellular carrier and stuff like that. So we'll program it and get it all set up for you and get it to you as quickly as we can. But we want it to be custom. We want it to be made for you. So we ask your indulgence. But we will ask you to wave your hands mightily or something like that and make yourself known so we can get that all set up. So So Erica's here. All the cards are there. I'm going to pick one, and you probably figure out how it goes from there. See, I'm nothing in my sleeves. There's a lot of cards in here. I'll take this one. There's one. Jackie Solano from Credit Suisse. That was excellent arm waving, Jackie. Very good. Okay, so our full day of presentations is over. We did take a poll of you about the weather and decided that the outdoor cocktail reception wasn't such a good idea. There were a few wingnuts who wanted to do it outside anyway, but we're going to do it inside. And if you go out these doors to your right, down the hall, the left, through the Pershing archway and take a right, you're going to come into the giant atrium in the middle on this floor where there's trees and stuff. And that is where we're having cocktails starting now. Thanks very much, folks.